Contributory versus non-contributory. The employer or other group sponsors may pay all of the premiums or share premiums with the employees. When an employer pays all of the premium, the plan is referred to as non-contributory plan. Under a non-contributory plan, an insurer will ensure that 100% of the eligible employees be included in the plan. When the premiums for group insurance are shared between the employer and employees, the plan is referred to as contributory plan. Under the contributory plan, an insurer will require that 75% of eligible employees be included in the plan. E. Retirement plans. Number 1. Qualified versus non-qualified plans. An employer-sponsored qualified retirement plan is approved by the IRS, which then gives both the employer and the employee benefits such as deductible contributions and tax-deferred growth. Quality plans have the following characteristics: designed for the exclusive benefit of the employees and their beneficiaries, and are formally written and communicated to the employees. Use a benefit or contribution formula that does not discriminate in favor of the prohibited group, officers, stockholders, or highly paid employees. Are not geared exclusively to the prohibited group, are permanent, are approved by the IRS, and have vesting requirements. Know this: quality have tax advantages. Qualified plans have tax advantages. In contrast, non-qualified plans are not subject to the requirements regarding participation, discrimination, and vesting found in qualified plans. Non-qualified plans require no government approval and are used as means for any employer to discriminate in favor of a valuable employee with regard to employee benefits. Non-qualified plans accept after tax contributions. Examples of non-qualified plans are individual annuities and deferred compensation plans for high-paid executives, split dollar insurance arrangements, and Section 162 executive bonus plans. The table below highlights the difference between qualified and non-qualified retirement plans. Under qualified, contributions currently tax deductible. Under non-qualified, contributions not currently tax deductible. Under qualified, plan approved by the IRS. Under the non-qualified, plan does not need an IRS approval. Under the qualified, plan cannot discriminate. Under the non-qualified, plan can discriminate. Under the qualified, earnings grow tax deferred. Under non-qualified, earnings grow tax deferred. Under qualified, all withdrawals are taxed. Under non-qualified, excess over cost basis is taxed. Number 2. Individual qualified plans, IRA and Roth IRA. The two most common qualified individual retirement plans are traditional IRAs and Roth IRAs. Anybody with earned income can contribute to either plan. A traditional individual retirement account IRA allows individuals with earned income to make tax-deductible contributions regardless of age. Previously, individuals were allowed to contribute to the account until the age of 70 and a half. However, the Secure Act of 2019 removed the prior age limit for all contributions starting in the tax year 2020. Plan participants are allowed to contribute up to a specified dollar limit each year or 100% of their salary. If less than the maximum allowable amount, individuals who are age 50 or older are entitled to make additional catch-up contributions. A married couple could contribute a specified amount that is double the individual amount, even if only one person has had earned income. Each spouse is required to maintain a separate account not exceeding the individual limit. In traditional IRAs, the owner may withdraw the funds at any time. However, withdrawals prior to age 59 and a half are considered early withdrawals and are subject to a 10% additional tax. Starting at age 59 and a half, the owner may withdraw assets without having to pay the 10% additional tax. However, the owner must start receiving distributions from the IRA at age 72. The Secure Act of 2019 raised the required minimum distribution age from 70 and a half to 72. Starting at age 72, the owner must receive at least a minimum annual amount known as the required minimum distribution RMD. The Roth IRA is a form of an individual retirement account funded with after tax contributions. An individual can contribute 100% of earned income up to an IRS specified maximum. As the traditional IRA, the dollar amounts change every year. Roth contributions can continue regardless of the account owner's age. And in contrast with the traditional IRA, distribution do not have to begin at age 72, previously 70 and a half. Both IRAs grow tax-free as long as the account is open for at least 5 years.
Bob and his wife have an adjusted gross income of $100,000 per year. Based on this income, Bob is not able to take a tax deduction on his traditional IRA contribution, so he decided to set up a Roth IRA account for his retirement contributions. Although Bob does not receive a tax break at this time, he will be able to withdraw funds from his Roth IRA tax-free at retirement, since he has left the monies invested for over 5 years.
Know this: traditional IRA and Roth IRAs are for individuals with earned income. Know this: contributions to a traditional IRA are with free tax dollars. Tax deductible contribution to Roth IRA are with after tax dollars, not tax deductible. Tax Taxation of IRA and Roth IRAs. The following taxation rules apply to contributions made to traditional IRAs plans. Tax deductible contributions for the year of the contribution based on the person's income. Contribution must be made in cash in order to be tax deductible. The term cash included any form of money such as cash, check, or money order. Excess contributions are taxed at 6% per year as long as the excess amount remains in the IRA and tax deferred earnings. The money that accumulates in the account are not taxed until withdrawn. A distribution from the IRA is subject to income taxation in the year the withdrawal is made. In case of an early distribution prior to age 59 and a half, a 10% penalty will also apply. There are certain conditions under which the 10% penalty for early withdrawals would not apply. Penalty tax exceptions. Participant is age 59 and a half. Participant is totally disabled. The money is issued to make the down payment on a home not to exceed 10,000 and usually for first-time home buyers. Withdrawals are for post-secondary education expenses, and withdrawals are the catastrophic medical expense upon death. The following taxation rules apply to Roth IRAs. Contributions are not tax deductible, and excess contributions are subject to 6% tax penalty. Note this: traditional IRA distributions are taxable. Roth IRA's distributions are not taxable. Traditional IRA and, and Roth IRA contribute 100% of income up to an IRS specified limit. Excess contribution penalty is 6%. Gross tax deferred on traditional IRA. Gross tax free if account open for at least 5 years in Roth IRA. Contributions are tax deductible, made with pre-tax dollars. Contributions are not tax deductible, made with after-tax dollars. Roth IRA. 10.5 penalty for early non-qualified distributions prior to age 59 and a half. Some exceptions apply. Distributions are taxable under traditional IRA. Qualified distributions cannot occur until the account is open for 5 years and owner is 59 and a half. Distributions are not taxable under the Roth IRA. Payouts must begin by age of 72. No required minimum age for payouts under the Roth IRA. Rollovers and transfers. Situations exist in which a person may choose to move the monies from one qualified retirement plan to another qualified retirement plan. However, benefits that are withdrawn from any qualified retirement plan are taxable the year in which they are received if the money is not moved properly. There are two ways to accomplish this: a rollover and a transfer from one account to another. A rollover is a tax free distribution of cash from one retirement plan to another. Generally, IRA rollovers must be completed within 60 days from the time the money is taken out for the first plan of the first plan. If the distribution from the first plan paid is paid directly to the participant, 20% of the distribution must be withheld by the payer. The 20% withholding of funds can be avoided if the distribution is made directly from the first plan to the trustee or administrator custodian of the new IRA plan. This is known as direct rollover. The term transfer or direct transfer refers to the tax-free transfer of funds from one retirement plan to a traditional IRA, or a transfer of interest in a traditional IRA from one trustee directly to another. Number 3. Plans for employers. In addition to additional plans, different types of qualified plans are available and have been designed for use by small and large employers. Self-employed plans, HR-10 or KEOGH. HR-10 or KEOGH plan made it possible for self-employed persons to be covered under an IRS qualified retirement plan. These plans these plans allow the self-employed individuals to fund their retirement programs with pre-tax dollars as if under the corporate retirement or pension plan. To be covered under a KOGH retirement plan, the person must be self-employed or a partner working part-time or full-time who owns at least 10% of the business. Contributions limits are the lesser or established dollar limit or 100% of their total earned income. The contribution is tax deductible and it accumulates tax deferred until withdrawal. Upon, uh, upon a participant's death, payouts can be available immediately. If a participant becomes disabled, he or she may collect benefits immediately or the funds can be left to accumulate when participant enters retirement. Distribution of funds must occur no earlier than 59 and a half and no later than 70 and a half. If withdrawn before 15 and a half, there is a 10% penalty. At any time, payments may be discontinued with no penalty and funds can be left to accumulate. Under eligibility requirement, any individual who is at least 21 years of age has worked for a self-employed person for 1 year or more and work at least 1,000 hours per year. Full-time must be included in the KOGH plan. The employer must contribute the same percentage of funds into the employee's retirement account as he or she contributes into his or her own account. Simplified Employee Pension Plan (SEP). The Simplified Employee Pension is a type of qualified plan suited for the small employer or the self-employed in a SEP. An employee establishes and maintains an individual retirement account to which the employee contributes. Employer contributions are not included in the employee's gross income. The primary Difference between a SEP and an IRA is much larger amount that can be contributed each year to a SEP. An IRA has established annual dollar limit or 25% of the employee's compensation, whichever is less. Simple plans. A simple savings incentive match plan for employees. Plan is available to small businesses that employs no more than 100 employees who receive at least 5,000 in compensation from the employer during the previous year. To establish a simple plan, the employer must not have a qualified plan already in place. Employees who elect to participate may defer up to a specified amount each year, and the employer then makes a matching contribution dollar for dollar up to amount equal to 3% of the employee's annual compensation. Taxation is deferred on both contributions and earnings until funds are withdrawn. Profit sharing and 401k plans. Profit sharing plans are qualified plans where a portion of the company's profit is contributed to the plan and shared with employees. If the plan does not provide an indefinite formula for figuring the profits to be shared, employer contribution must be systematic and substantial. A 401k qualified retirement plan also employees to take a reduction in their current salaries by deferring an account into a retirement plan. The company can also match the employee's contribution whether it is a dollar for dollar or on a percentage basis. Under a 401k plan, participants may choose to either receive taxable cash compensation or have the money contributed into the 401k, referred to as a cash or deferred arrangement plans (CODA). Contributions into the plans are excluded from the individual employee's gross income up to a dollar ceiling amount. The ceiling amount is adjustable annually for inflation. The plan allows participants aged 50 or over to make additional catch-up contributions up to a limit at the end of the calendar year. Plans permits early withdrawal for specified hardship reasons such as death or disability. Loans are also permitted in certain instances up to 50% of the participants' vested accrued benefit or a specified dollar limit set by the IRS annually. 403b tax sheltered annuities. A 403b plan or tax sheltered annuity is a qualified plan available to employees of certain non-profit organizations under Section 501c3 of the Internal Revenue Code and to employees of public school systems. Contributions can be made by the employer or by the employee through salary deduction and are excluded from the employee's current income. As with any other qualified plan, 403b limits employees' contribution to a maximum amount that change annually adjusted for inflation. The same catch-up provisions also apply. Note this, 403b plans are for non-profit and public school systems. The HR 10 KOGH, the eligibility is self-employed. Who contributes? Employers matches employees' contribution. Under the SEP, the eligibility are small employer or self-employed. Who contributes? Employer only. Under simple, with the eligibility of small employers no more than 100 employees. Who contributes? Employer matches employee's contribution. 401k, the eligibility any employer, and who contributes? Employer matches employee's contribution. Under the 403b-TSA, the eligibility are non-profit organizations, and who contributes? Employer and employees. Know this, contributions to qualified plans are limited to a maximum amount established by the IRS. Life insurance needs analysis and suitability. Number 1. Personal insurance needs. Survivor protection. The death of the primary wage earner will usually stop the flow of the income to a family. The death of a non-earning spouse who cares for minor children can also cause great financial hardship for the survivors. Life insurance can provide the funds necessary for the survivors of the insured to be able to maintain their lifestyle in the event of insurer's death. This is known as survivor's protection. Planning for survivor protection requires careful examination of current assets and liabilities, as well as determining what survivors' needs may be. Cash accumulation. Life insurance may be used to accumulate specific amounts of monies for specific needs with guarantees that the money will be available when needed. For example, some life policies, those that provide permanent protection such as whole life, accumulate cash value that is available for the policy owner during the policy term. Liquidity. As a result of the cash accumulation feature, some life insurance policies provide liquidity to the policy owner. That means the policy's cash values can be borrowed against at any time and used for immediate needs. Estate creation. A person may create an estate through earnings, savings, and investments, but all of these methods require disciplined action and a significant period of time. The purchase of life insurance creates an immediate estate. Estate creation is especially important for young families that are getting started and have not yet had time to accumulate assets. When an insured purchases a life insurance policy, he or she will have an estate of at least that amount the moment the first payment is paid. There is no other legal method by which an immediate estate can be created at just a small cost. Estate compensation. Life insurance proceeds may be used to pay inheritance taxes and federal estate taxes so that it's not necessary for the beneficiaries to sell up the assets. Number two, business insurance needs. Businesses use life insurance for the same reason individuals use life insurance. It creates an immediate payment upon the death of the insured. The most common use of life insurance by businesses is an important benefit, which serves as a protection for employees and their beneficiaries. There are also other forms of life insurance that can serve business owners and their survivors and even protect the business itself. This include funding, business continuation agreements, compensating executives, and protecting the business against financial loss resulting from the death or disability of key employees. Key person. A business can suffer a financial loss because of the premature death of a key employee, someone who has specialized knowledge, skills, or business contacts. A business can lessen the risk of such loss by the use of key person insurance. Key person insurance may be issued as a term of permanent life, with whole life and universal life policy being used most often. With this coverage, the key employee is the insured, and the business is all of the following: applicant, policy owner, premium payer, and beneficiary. In the event of death of a key employee, the business would use the money for the additional cost of running the business and replacing the employee. The business cannot take a tax deduction for the expense of the premium. However, if the key employee dies, the benefits paid to the business are usually received tax free. No special agreement or contracts are needed except that the employees will need to give permission for this coverage. Buy-sell funding. Buy-sell agreement is a legal contract that determines what will be done with the business in the event that an owner dies or becomes disabled. This is also referred to as a business continuation agreement. There are several types of buy-sell agreements that can be used for partnership and corporations. Cross purchase. Used in partnership when each partner buys a policy to the other. Entity purchase. Used in when the partnership buys the policies on the partners. Stock purchase. Used by privately owned corporations when each stockholders buys policy on each of the others. And stock redemption. Used when the corporation buys one policy on each shareholder. Example. Here's an example of cross purchase buy sell agreement. Partnership AB has two partners, A and B. The value of the business is 1 million. The business each have an equal interest, 500,000 each. A buyer a, A buys a life policy on B for 500,000 and B buys a life policy on A for 500,000. If A dies, B gets 100% ownership of the business and A's heirs receive 500,000.
Sam and Larry are partners in a small but successful law firm. Concerned about the future of their business in case one of them dies or becomes disabled, they consulted their insurance agent, who recommended writing up a buy-sell agreement to ensure the continued existence of the company and to prevent the family of the deceased from taking over the business. Buy-sell agreements can be funded with life insurance, which would pay out the death benefit to the family of the deceased partner. The surviving partner will then be allowed to purchase the business share of the deceased at a specified rate and in accordance with the established terms and conditions.
Executive bonuses. Executive bonus is an arrangement where the employer offers to give the employee a wage increase in the amount of the premium on a new life insurance policy on the employee. The employee owns the policy and therefore has full rights to the policy. Since the employer treated the premium payment as a bonus, the amount is tax deductible to the employer and income taxable to the employee. It is assumed that if the employee were not willing to accept these conditions, the employer would not provide the benefit. Executive bonus plans are not subject to plan limits established by the IRS for qualified plans, so it is considered a non-qualified benefit plan. G. Tax treatment of insurance premiums, proceeds, dividends. Generally speaking, the following taxation rules apply to the life insurance policy. Premiums are not tax deductible and death benefit tax-free if taken as a lump sum distribution to a named beneficiary. And principal is a tax-free. Interest is taxable and paid in installments after the lump sum.
Harry purchased a $200,000 life insurance policy with an annual premium of $1,200. Although the $1,200 premium is not tax deductible, when Harry dies, his family will receive a $200,000 death benefit tax-free if taken in a lump sum. If Harry's beneficiary takes the payment of the benefit in installments, the interest portion of each installment will be federally taxable.
Amounts available to policy owners. As you already learned, permanent life insurance provides living benefits. There are several ways in which policy owners may receive those living benefits from the policy. Dividends. Since dividends are return of unused premiums, they are not considered income for tax purposes. When dividends are left with the insurer to accumulate interest, the interest earned on the dividend account is subject to taxation as ordinary income each year. Interest is earned whether or not the interest is paid out of the policy owner. Cash value accumulations. Any cash value accumulations in a policy can be borrowed against by the policy owner or may be paid to the policy owner upon surrender of the policy. Cash values, gross tax deferred. Upon surrender or endowment, any cash values in excess of cost basis premium payments is taxable as an ordinary income. Upon that, the face amount is paid and there is no more cash value. Death benefits generally are paid to the beneficiary income tax free.
Over the life of a policy, as the cash value increases, there will be no annual taxes due, since the growth is tax deferred as long as the cash value remains inside the life insurance policy.
Policy loans. The policy owner may borrow against the policy cash value. Money borrowed against the cash value is not income taxable. However, the insurance company charges interest on outstanding policy loans. Policy loans with interest can be repaid in any of the following ways: by the owner while the policy is in force, at policy surrender or maturity, subtracted from the cash value, or at the insured's death, subtracted from the death benefit. Note this: policy loans from the cash value are not taxable. Surrenders. When a policy owner surrenders a policy for cash value, some of the cash value received may be taxable as income if the cash surrender value exceeds the amount of the premiums paid for the policy. When the owner withdraws cash value from a universal life partial surrender, both the cash value and the death benefit are reduced by the surrender. Example: consider the following scenario. Face amount is $300,000. Premiums paid $70,000. Total cash value is $100,000. If the insured surrendered $30,000 of cash value, the full $30,000 would be income tax free. If the insured took out $100,000, the last $30,000 would be taxable because the $100,000 exceeds the premiums that were paid in by $30,000. Accelerated benefits. When accelerated benefits are paid under the life insurance policy to a terminally ill insured, the benefits are received tax-free. When accelerated benefits are paid to the chronically ill insured, for example, someone who has cancer, Alzheimer's disease, or other severe illness, these benefits are tax-free up to a certain limit. Any amount received in excess of this dollar limit must be included in the insured's gross income. Number 2. Amounts received by beneficiary, general rule and exceptions. Life insurance proceeds paid to a named beneficiary are generally free of federal income taxation if taken as a lump sum. An exception to this rule would apply if the benefit payment results from a transfer for value, meaning the life insurance policy is sold to another party prior to the insured's death. Note this: lump sum cash value of life policy proceeds are tax-free for the beneficiary. Settlement options. With settlement options, when the beneficiary receives payment consisting of both principal and interest, the interest portion of the payments received is taxable as income. Example: if $100,000 of the life insurance proceeds were used in a settlement option, paying $13,000 per year for 10 years, $10,000 per year would be income tax free and $3,000 per year would be income taxable. Note this: in settlement options, the principal is tax free but the interest is taxable. Permanent life features. Premiums. In tax treatment, they're not tax deductible. Cash value exceeding premiums paid under permanent life features. In tax treatment, taxable at surrender. Policy loans. In tax treatment, they're not income taxable. Policy dividends. Under tax treatments, they're not taxable. Dividend interest under permanent life features, taxable in a year earned in tax treatment. Lump sum death benefit under tax treatment, not income taxable. Note this: taxes must be paid either upon contributions or upon distribution, not both. If taxed on one end, will not be taxed on the other. Number 3. Group life and employer sponsored plans. The premiums that an employer pays for life insurance on an employee, whereby the policy is for the employee benefits, are tax deductible to the employer as business expense. If the group life policy coverage is $50,000 or less, the employee does not have to report the premium paid by the employer as income, not taxable to the employee. Anytime a business is the named beneficiary of a life insurance policy or has beneficial interest in the policy, any premiums that the business pays for such insurance are not tax deductible. Therefore, when a business pays the premiums for any of the following arrangement, the premiums are not deductible. Key employees, key employee and key person insurance, stock redemption or entity purchase agreement, and split dollar insurance. The cash value of a business owned life insurance policy or an employer provided policy accumulates on a tax deferred basis and is taxed in the same manner as an individual owned policy. Policy loans are not taxable to a business, unlike an individual taxpayer or corporation may deduct interest on a life insurance policy. Loans were loaned up to $50,000. Policy death benefits paid under business owned or an employer provided life insurance are received income tax free by the beneficiary in the same manner as in individual owned policies. If the general requirements for qualified plans are met, the following tax advantages apply. Employers' contributions are tax deductible to the employer and are not taxed as income to the employee. The earnings in the plan accumulate tax deferred, and lump sum distributions to employees are eligible for favorable tax treatment. Number 4. Modified Endowment and Contracts (MEC). Following the elimination of many traditional tax shelters by a Tax Reform Act of 1984, single premium life insurance remained as one of the few financial products offering significant tax advantages. Consequently, many of these types of policies were purchased solely for purposes of setting aside large sums of money for the tax-deferred growth as well as tax-free cash flow available via policy loans and partial surrenders. To curtail this activity and to determine if insurance policy is overfunded, the Internal Revenue Service established what is known as the 7-pay test. Any life insurance policy that fails a 7-pay test is classified as Modified Endowment Contract (MEC) and loses the standard tax benefits of a life insurance contract. In a MEC, the cumulative premiums paid during the first 7 years of the policy exceeds the total amount of net level premiums that would be required to pay the policy up using guaranteed mortality costs and interest. Once a policy fails the 7-pay test and becomes a MEC, it remains a MEC. Note this, a MEC is an overfunded life insurance policy equal failed the 7-pay test. Note this, once an MEC, always a MEC. All life insurance policies are subject to a 7-pay test, and at any time there's a material charge to a policy such as an increase in the death benefit, a new 7-pay test is required, whether from life insurance policy or a MEC. The death benefit received by the beneficiary is tax-free.
Tyler is a very successful professional who enjoys an active lifestyle. To protect his family, he purchased a whole life insurance policy 5 years ago and has been paying extra premiums to accumulate the cash value faster. Unfortunately, because Tyler paid a large amount of premium into the policy too quickly, his premiums have exceeded the 7-pay limit, which turned Tyler's life insurance policy into a modified endowment contract.
The following are taxation rules that apply for MEC's cash value. Tax-deferred accumulations. Any distributions are taxable, including withdrawals and policy loans. Distributions are taxed on LIFO basis, last in, first out, known as interest first rule, and distributions before age 59 and up are subject to a 10% penalty. Tax consideration for life insurance and annuities. Premiums and not not deductible personal expense. Death benefit, not income taxable except for interest. Cash value increases, not taxable as long as policy in force. Cash value gains, tax at surrender. Dividends, not taxable return upon used premiums. However, interest is taxable. Accumulations, interest taxable. Policy loans, not income taxable. Surrenders, surrender value, past premium equal amount taxable. Partial surrenders, first in, first out. Settlement options, Death benefits spread evenly over income period average. Interest payments in excess of death benefit portions are taxable. Estate tax. If the insured owns the policy, it will be included for estate tax purposes. If the policy is given away, possibly to a trust, and the insured dies within 3 years of the gift, the death benefit will be included in the estate. FIFO applies to life insurance only. Annuities allows a LIFO format. Age, Social Security benefits. Social Security, also referred to as Old Age Survivors Disability Insurance, OASDI, is a federal program enacted in 1935 which is designed to provide protection for eligible workers and their dependents against financial loss due to old age, disability, or death, with a few exceptions. Almost all individuals are covered by Social Security. In some aspects, Social Security plays a role of federal life and health insurance, which is important to consider when determining an individual needs for life insurance. Social Security uses quarter of coverage (QC) system to determine whether or not an individual is qualified for Social Security benefits. The type and amount of benefits are determined by the amount of credits or QCs a worker has earned. Anyone working in jobs covered by Social Security or operating his or her own business may earn up to maximum 4 credits for each year of work. The term fully insured refers to someone who has earned 40 quarters of coverage, the equivalent of 10 years of work, and is therefore entitled to receive Social Security and retirement, premium-free Medicare Part A, and survivor benefits. If an individual is entitled to a premium-free Medicare Part A, they are automatically eligible for Medicare Part B, must pay a monthly premium. An individual can attain a currently insured status or partially insured and by that qualify for certain benefits if he or she has earned 6 credits or quarters of coverage during the 13-quarter period ending with the quarter in which the insured dies, become entitled to a disability insurance benefits, or become entitled to old age insurance benefits. For younger workers, the number of quarters required to qualify for the benefits differs by the age according to the table established by Social Security. Conditions for payment, paid to, and type of payment. The retirement benefit, fully insured status and age 66 or reduced benefits at age 62. Paid to retired individuals and eligible dependents. Type of payment, monthly benefit equal to the primary insurance amount, PIA. Disability benefit, fully insured status and total and permanent disability prior to the retirement age. Paid to disabled worker and spouse and eligible dependents. Type of payment, monthly disability benefit after a 5-month waiting period. Survivor benefit, worker's death. Paid to surviving spouse and dependent children. Type of payment, lump sum, burial benefit if fully or currently insured. Monthly income payments if fully insured. The current full retirement age is 66 and is gradually increasing to age 67. Chapter recap. This chapter continued the discussion about different types of life insurance products, group plans, and third-party plans, and qualified and non-qualified plan options for the individual and businesses. You have also learned some basic principles of taxation for life insurance and annuities. Let's recap the major points. Third-party contracts. The general features. The policy owner and the insured are not the same person. Policies written for minors or for businesses. The viatical settlements. Viator is the insured who has a terminal illness. Viator receives a percentage of the policy's face amount. Life settlements. Policy owner sells the life policy that is no longer needed to a third party. Insured does not have to be terminally ill. Absolute assignments. Group life insurance. General features. Employer is the policy owner, receives a master contract. Employees are the insured, receive certifications of insurance. No evidence of insurability. Conversion. No evidence of insurability within a specified number of days, usually 30 or 31 days of termination. Non-contributory. Non-contributory. Employees pays 100% of the premiums, requires 100% employee participation. Contributory. Employer and employees share the costs of premiums, requires 75% of participation. Qualified plans. General features approved by the IRS. Tax benefits for employers and employees. Must be permanent and have vesting requirement. Cannot discriminate in favor of the prohibited program. Individual qualified retirement plans. Traditional IRA. Earned income. Pre-tax contributions. Contributions. No limiting age. Recent law change. Dollar limit up to a maximum allowed amount. Married couples double the amount for singles. Withdrawals may be given at age 59 and a half, but no later than age 72. Roth IRA, earned income, after tax contributions. Contributions, no limiting age. Dollar limit up to maximum allowed amount. Withdrawals do not have to begin at age 72. Employer-sponsored qualified plans. Contributions up to IRS specified amount. Both employers and employees can contribute. Types of plans. HR10, KOGH, self-employed. SEP, small employer, self-employed. Employer sponsors employees IRA. Simple, small employer, no more than 100 employees, set up as IRA or as a 401k. 401k, any employer, cash or deferred arrangement, profit sharing. 403b, non-profit organization, a tax-sheltered annuity. Taxation, life insurance, premiums not tax deductible. Cash value, taxable only if the amount exceeds premiums, tax on gain. Policy loans, not taxable, interest not tax deductible. Dividends, not taxable as return to the employee. Premium, any interest is taxable. Death benefit, not taxable if lump sum, any interest is taxable. IRA. Contributions pre-tax dollars tax deductible must be made in cash. Earnings the deferred. Distributions taxable 10% penalty for early withdrawals. Roth IRAs contributions after tax dollars not tax deductible. Distribution not taxable. Business insurance employer contributions tax deductible to the employer, not taxed as income to the employee. The earnings grow tax deferred. Lump sum contributions to employees have favorable tax treatment. Other related concepts rollover and transfers, tax-free transactions, distribution of money from one qualified retirement plan to another must be completed within 60 days. If from a plan to the participant, 20% of the distribution is withheld. If from plan to trustee, no withholdings, direct rollover. Modified endowment contract, MEC. Overfunded life insurance policy, 7 days test. Accumulation, tax deferred. Distribution, taxable, last in and first out. Distribution before age 59 and a half, 10% penalty. Social Security benefits, types of benefits, retirement, disability, survivor. Insured status, fully insured, 40 quarters of coverage, qualified for Social Security, retirement, Medicare, and survivor benefits. Currently insured, 6 quarters of coverage, qualified for some benefits.
This chapter covered a wide range of topics related to life insurance. Let's see how well you were paying attention. In group life insurance, who receives the master contract? The employer. Can you give some examples of qualified retirement plans? Traditional IRA, Roth IRA, Simple, SEP, and 401k. When would life insurance death benefits be tax-free? If paid as a lump sum to the beneficiary. Did you get all the answers? Before moving on, take time to reflect upon the learning objectives for this chapter. Understand the concept of third-party ownership. Know the difference between a viatical settlement and a life settlement and when each can be exercised. Understand the differences between individual and group insurance. Know the major types of coverages specifically designed for businesses. Describe the differences between qualified and non-qualified retirement plans. Understand general taxation rules for policy premiums, dividends, and death benefits. Know what Social Security benefits are available and how those benefits are determined. You've completed the general knowledge portion of your course, and now you're ready to move on to state regulations. You should be proud of yourself for getting this far. You're doing great.
Practice questions. Chapter 1. Chapter recap. Social Security was created to provide all of the following benefits except unemployment income. Social Security is designed to provide protection against financial loss due to old age, disability, or death. It also provides income during retirement. What is the official name for the Social Security program? Old Age Survivors Disability Insurance. Social Security is formerly called Old Age Survivors Disability Insurance, OASDI. Social Security was created to provide all of the following benefits except